that and consider that buying strength. I tried that and got my ass handed to me. I could never make that work for myself. I'm not saying that it doesn't work or that he didn't make money with it, because he clearly did. I couldn't make that work. So I understand when I teach a specific concept, and it might be the balanced price range, that you're probably looking at this is too complicated. Don't worry about it. Stick to the things that make sense. I did the same thing. I had a love and an adoration for Mr. Williams when I was learning all this stuff. I trusted him with everything. Okay, I was literally throwing money in brokers' accounts just to test a new thing I learned that day. Okay, so I mean, it was. I understand what it's like, the fanfare that comes around somebody that you have a lot of affinity for, but don't do that with my concepts. And really spend time with measuring what it is that makes sense to you, that you've done the due diligence and back testing and seeing what one of these PD arrays that makes sense to you. And the obvious ones, the easiest ones that you see, that's the one you spend the most time with. And most of you are going to determine your model is linked to that. And bloom where you're planted. Don't try to tinker with it too much. All you're trying to do is find something that separates from where the market is right now, where it's likely to go, and measure risk that you can afford to take as a loss. And then you repeat that over and over again. And that's profitability. That's consistency. That's continuity, which brings longevity. You don't want to be a one-hit wonder, get a 5-figure withdrawal from a funded account and say, hell yeah, I'm balling. That's not success. That's what everybody's treating it like right now. They want to get funded and get a lottery win. Okay? I'm not teaching you how to be a lottery trader. I'm teaching you how to be a long-term, consistently profitable trader. But that doesn't happen overnight. Some of you think you can make it happen like that. It doesn't work like that. It doesn't, because you're going to bring in all kinds of things that you have to wrestle with. And you're going to swear up and down that something I'm going to teach or taught or will teach is the replacement for what you think is the best thing for you. Every time I bring something new, you're going to question the thing that may be showing you evidence that this is your model right now. Don't let me sway you with something new. It'll always be on the YouTube channel. Whatever I'm teaching is going to stay up. But wherever you start seeing success, even in the early stages, don't abandon that. You have to give yourself time, and you have to stick with something long enough to know that you have a foundation in it. And you're going to see that all these PD arrays lean on one another. It's like a web that it's a whole entire structure. When I look at price, I'm seeing all of it at one time. Some of the things I want to see, I have to wait to see if they're going to manifest. And that's usually on the heel end or backside of a high impact or a medium impact news driver. All right, so let's go into a 5-minute chart. Excuse me. All right, so we have all the balanced price range equilibrium. We have the breakaway gap. We traded above. We have a down close candle. So what is this? What's this down close candle? Bullish order block. Does it have a fair value gap? Right there. What time of day is that? 10:05. What time is that? That's your AM session silver bullet. So ICT silver bullet. You can trade this gap right here, which would be encapsulated here. What time do you start looking for an ICT silver bullet trade? If you're trading in the 1 hour spectrum of 10 a.m. to 11 a.m., you start with your 15-minute down to 5, 4, 3, 2, 1. If you don't see it in the 1 minute or higher, drop down into the seconds charts. If you're adamant about finding one, it will be there. It will absolutely be there. Let me tell you why. Okay, here's the why behind a silver bullet. Okay, there is always, folks, just like a partial profit pays every fucking time. It's 100% profitable. When you take a partial profit, it never fails to pay you. That's why I teach you to do it. You're always winning taking a partial. It never, ever, ever fails to put more money in your account. Think about that. And there's dumbasses out there that'll tell you taking partials is the stupidest shit they've ever heard, because you incur the initial risk and you take less than you tried to make when you first put the trade on. You don't fucking know if that market's going to go there, Yahoo. And you, as a new developing student, you have no idea it's going to do that either. So when it gives you the opportunity to take money out, you do it. And over time doing that, you learn more about yourself. You learn more to trust. Okay, I've seen this before. Let me expand outside my comfort zone. This is where I normally take the majority of my trade off. Let me just take a small portion and move my stop to break even and graduate in my experience and seeing what it feels like to go into these scary moments, but still taking profits. Nobody, no fucking Buck Rogers jumped out there and said, I know how to trade. This is the model I'm going to do, and it's full bore, full pull, no partials, and I'm doing it all the time. That's an asshole. Okay, that's an asshole that tells you that, and it's an asshole that's telling you to trade like that. You don't know when these markets are going to have manual intervention. You have no idea when it's going to turn on you. Nobody knows that. If I didn't have the respect of the risk that's available in these markets, I wouldn't use a stop loss. And I'm the guy teaching you. I'm telling you, I get pissed off when I see students sending me their screenshots of their trades that are open. The first thing I'm looking for is where their stop loss is. And I usually bite my tongue because I don't want to embarrass them. But if you're sending me tweets and you're sending me your open profit trades, whether it be live or demo or funded account, if you don't have a stop loss on there, just know that I'm cringing. I'm cringing because you're not using a stop loss. That means you're fucking gambling. You assume that you're absolutely right. There's no way you can be wrong. And I don't even think that. I authored all this shit and I still have to use a stop loss. Because you don't know when chaos is going to show up. You don't know when uncertainty enters the chat. Some unexpected event, some bomb drops somewhere, someone declares, WA, are you paying attention? So, why do silver bullets work? Why will they form? Because there's always going to be displacement between 10 o'clock and 11. Why? This is the part where you take notes, folks, okay? In the hour of 10 o'clock and 11 o'clock in the morning, New York local time, what has happened already? The market opens at 9:30. The opening bell, I mean, we've been trading all night long, but the opening bell happens. Ding, ding, ding. Everybody's now paying attention. Everybody's clapping their hands. I never understood what the fuck they're clapping for. But the bottom line is that markets open. 9:30, bells ring. Now everybody's rushing out there to buy and sell stocks. Great. Retail trader John Q. Public is watching the ticker tape and he's saying, okay, my stock opened up $2 more where it closed yesterday. This is amazing. I'm making money. Well, that gap's going to close likely, and then it drops down. Then after that gap fills, if it fills at all, then there's new sentiment that shifts. Okay, it either overlaps that gap and breaks down, then it treats the low of the gap as resistance and keeps going lower, or it fills the gap, rallies up, treats the high of the gap as support, and then continuously moves higher. There's your gap theory right there. Use that with new week opening gap, new day opening gap, any fair value gap, any real liquidity void. That's how you treat it. Now, what separates the support behind that gap is the consequent encroachment, the midpoint, how we trade there at time of day. At 10 o'clock, we have 30 minutes behind us, which is why I tell you the 30-minute opening range, that's important. Every algorithm uses that first 30 minutes. Every one of them. They use that to refine a very specific range to look for inefficiencies and allow sometimes liquidity to form below or above it, and they'll do another pass, go back below it, take stops out, and then run through. Or don't return back into it at all, but just half of it. And then it runs higher or lower in deference to whatever the bias would be for that day. But the main takeaway is at 10 o'clock, you have 30 minutes of trading after the opening bell. So that initial flurry of rush to do something, John Q. Public is doing their trading then. And they're usually apt to be wrong. So we allow for that to take place. We don't have any bias ahead of time. We don't care. And we wait and see where price delivers from 9:30 to 10 o'clock. Now at 10 o'clock, we refer to where we think price is going to go anyway. where we've been calling price for NASDAQ.